Hey everyone, welcome back to yet another interesting video from Trading with Groww YouTube channel. My name is Nataraj Malvade. In today's video, I'm going to discuss about candlestick analysis. If you are struggling to understand candlestick charts or if you are a complete beginner to this particular concept, then this video is for you. By the end of this video, you'll have a complete clarity of what candlestick analysis is and what are the different candlestick patterns and how to read them and read the psychology behind individual pattern is what we are going to discuss. Definitely this video is going to be an elongated session because it is going to be a detailed discussion of candlestick analysis, so watch this video till the end to get the complete clarity. So let's get started. First thing first, the basics of candlestick charts or how to plot the candlestick charts. In order to do this, there are two important points we need to understand. The first one is the body or the entire block of the candlestick charts and the wicks or the shadow. So based on these two important parameters or two important elements, the entire candlestick charts are formed. So let's understand them in detail now. You can see here, let me draw the block here. So the block that you see on the candlestick chart is what we can call it as a body. And we have two important points here which are basically called as a wick or the shadow. So if you just look at the pattern, it just looks like a candlestick, so that we regularly use in our home. So this is the body of the candle, from this point to this point is the body, and the remaining part of the candlestick charts we can call it as the wick or the shadow. Let me note down. We can call it as a wick or shadow. So these two parts together form a candlestick charts, and by using the candlestick charts we can see the four important data points of the price. So at any given point of time frame, it may be 5 minutes, 15 minutes, 30 minutes, 1 hour, it doesn't matter, you need a certain time frame. So in that particular certain time frame, market will move up and down. So in that we get four important data points, and by using those data points we are going to plot the candlestick charts here. So this is how the overall candlestick chart looks, but here let me mark those levels. Assume that this is the open. Okay, that means in this particular time frame market opened and it is assuming that it is 80. Okay, so that means 80 rupees market opened here, and assume that this point is the close. Okay, so I'm going to mark it as a C. Close is at 120. So with this we can clearly see that the entire body represents the data points of the price, open and the close, and the remaining part, this particular data point we can call it as the high, assuming that in this case it is 140, and this level, the lowest extreme of the candlesticks, is what we can call it as the low, that represents the low, and in this we can assume it as 60. So the moment we see this particular candlestick chart, so we can easily observe four important data points: open, high, low, close, and where the market opened 80 rupees, where the market closed 120 rupees. In between that, market traded to the extreme levels. Highest extreme point is what we can call it as the high of the candle, which is 140, and in this case the lowest extreme point is 60 rupees. But here is the catch. It just not represents the data point, but if you just look at the overall pattern here, it is representing the psychology and the strength between the buyer and the seller. So for example, in this case, let me mark the body with a green color. Color indication is important. Basically this is a positive candle. How I am saying that? Basically because market opened here at 80 rupees and it traded all along till 140 level, and after that buyers failed to trade above 140 rupees, and again market traded to the lower levels, and sellers tried to push price below 60 rupees but they failed, and after that market again pushed back and it closed at 120 rupees. So with this we can clearly see that the entire time frame, the overall time frame of this candle, buyers was in the strength because market closed above the open, and this particular candlestick is what we can call it as positive candle or a bullish candle also. Color really doesn't matter, but the concept behind this color is very important. Why we are saying it as a bullish candle is because the close is above the open at the end of the time frame, at the end of the day or at the end of the 5 minutes, doesn't matter. At the end of the time frame, you know that the buyers were in control and they were able to close the price above the open. That is the reason why we are calling it as a positive candle or the bullish candle. Now let's look into the other example which is opposite to this. So here again we have the block, and but this time we again have the shadows here. Even though candle is looking the same, the data point varies here. Observe this carefully. Highest point remain the same, which is 140 in this case. This is an example. So lower point remains the same, which is 60. But what differs is the open. Assume that the market opened at 120 rupees. Okay. Market opened here, and after that market closed at 80 rupees. In earlier example, market closed at 120 rupees, which was higher than the open, which was 80 rupees. But in this case, market closed below the open. In that case, it represents the bearishness, because with this data point, we can easily say that the bears were in control. And by the end of this time frame, we can easily call it as a bearish candle or the negative candle. So this is exactly the importance of candlestick charts. By just looking at the candlestick charts at that particular time frame, what happened, who were in control, what is the psychology behind the entire structure is what we understand. How to understand the psychology behind those patterns is what we are going to understand now. Broadly, there are two kind of patterns involved here. One is the single candlestick pattern. That means by just looking at the single candle, single time frame, we are going to define certain patterns. And in that second type of patterns is the double or multiple candlestick patterns. Let me mark it here. The first one is the single candlestick, and second one is multiple candlesticks. So in this, let's now look into the single candlestick patterns. In that, the first one that I'm going to discuss is Morubozu. Don't worry, I'm going to simplify it for you. So basically, Morubozu means the bald head. That means person without hair. In this, the pattern looks like this. Let me draw it. So basically, this is how the patterns looks like. The moment you see it, you can easily observe here. In Morubozu candle, you won't see the shadow or the wick. That is the main pattern that indicates basically the strength of the particular player or the individual player. Assume that in this particular case, market opened here and market closed here. Since there are no wicks, the extremity is remain the same, which is close and the open. The open itself is the low and close itself is the high. In that particular case, we can easily see from the market open, complete strength or the complete control were in the hand of buyers. So when this particular pattern happens, we can easily assume at that particular point of time or the time frame, buyers were in complete control, and the possibility of market making further movement in that particular direction is quite high. So this is the logic behind Morubozu. Assume in the same case, suppose market opened here and market closed here. That means it indicates the negative bias in the market, negative strength in the market. Sellers were in clear control from the open itself. So that is the importance of this particular candlestick. In this case, open itself is the high and close itself is the low. But in the realistic chart, it will not look like this. There will be a shadows, but very negligible shadows like this. Even in that case also, we can call it as a Morubozu candle. So this is the theory behind Morubozu, but let's see in the chart how it looks like. I'm going to utilize the Groww charting platform here. If you don't have the account, we are going to leave the link in the description to open the account. By using that, you can open the Groww app and access the technical analysis chart. You can see here, let me open the chart. So here, the recent example of the Nifty, this is a daily time frame. So basically after completion of the day, you will have a 4 important points, and based on that you are plotting the candlestick charts here. So here we can easily point the Morubozu candles. The recent examples, you can see this one was the negative Morubozu, and here also we have the negative Morubozu. That means from the market open itself, market closed with a clear dominance of the selling pressure. Let me zoom it further. Yep. So this is where we have the, so this particular candle is what represents the bullish Morubozu. That means from the market open, you can see this was the open and this was the close with a little negligible shadow upper side, but you can see after that, boom. So market moved upwards and still it is continuing the upward momentum. So this is the importance of this particular candlestick patterns. Well, now let's move on to the next important pattern. One of my favorite pattern too, because the importance of it is very evident and very critical. and it can be easily seen. So this is how something it looks like. Assume that this is the body, and let me draw the wick. So people call it by a hammer pattern because it looks like hammer. Let me note down it. It's a hammer pattern because it looks like a hammer, but in price action we can also call it as a pin pattern. The main importance of this pattern is, let me mark the levels here, you will have a complete clarity. So let's start from the open. Assume that market opened here and market closed here. The first important impression or the first important point that we need to observe here is the body is narrow compared to the entire wick. You can see this entire length of the wick is higher comparing to the body. That is one important observation. And after that, assume that it is the open and this is the close, and this is the high and this is the low point. The movement we see here, let's look into, or let's try to understand the pattern here. Market opened here, market tried to push above this particular level, but buyers failed to do so. And after that there was a huge selling pressure. How can see that? Because market extended its extremity towards this particular level, but sellers failed badly, and again buyers took the control of the entire price action, and again market closed above the open. This indicates the major strength of the buyers here. So the moment we see the higher or the lengthier wick at the lower level of the body and the shorter wick at the upper level of the body, then we can call it as the positive candle or positive strength candle. So this particular pattern we can call it as a hammer because it looks like a hammer. But now in the same case there is another pattern which is called as shooting star. Even it looks like the same candle, the logic behind the methodology, entire logic behind the candlestick remains the same, but the name is different for this pattern. Let me tell you why. So assume that this is, okay, I'm very bad at drawing the lines. So this is the upper wick and this is the lower wick, and as we can see that the body is narrower compared to the entire shadow or the wick. And in this case market is indicating, assume that this was the open and this was the close and this was the low and this was the high. So in this case we can easily see, if you read the pattern here, market opened here, market tried to trade below this particular level but it failed, and again there was a strong buyer strength and buyer push to this particular level, but buyers failed badly because they closed, or the entire auction or the price action closed below the open at the end of the day or at the end of the time frame, which indicates that the complete strength or the complete price action was to control by the sellers. So this is the indication of this particular pattern, and this we can call it as a shooting star. So the name is not important here, the psychology behind this particular pattern is very important. One of the powerful candlestick charts or the candlestick pattern we can say, especially when it forms at particular critical levels. I'm going to explain that particular part in the later section. So assume that the market is moving upwards. Okay, assume that market is moving upwards, but here we got the shooting star, which indicates what? First thing, the momentum of the buying momentum closed here because the sellers took the control and they badly closed market, and the negative bias, the sellers were in control. And in this particular case, suppose if there is any particular resistance or any particular critical levels and that particular time it happened, that means it adds a lot of importance to this particular pattern, and there is a higher possibility of market trading to the lower levels after forming of the shooting star at the critical levels when the market was trading in the bullish momentum or the positive trend. Similarly, if the market is moving downwards and we got a hammer pattern here, in that case there is a higher possibility of market returning or market reversal to the positive side. So let's look into the chart. So far we have discussed about the theory of this particular pattern, one of the powerful pattern I can say. Let's look into the chart and see how this particular pattern looks in the real world. So here in this particular chart we can see these patterns, how this is working in the real world. So as you can see, this is the hammer candle. So basically market was trending downwards. From this particular point market was trending downwards, but once we formed the hammer pattern we can see the trend reversal in the entire bearish momentum. And now as you can see here, market was trending upwards, but at the peak we got the shooting star or the negative biased hammer, you can say. The pattern is important here, so you can easily see that the market opened here and market closed here, and after that there was a reversal in the entire trend. So now let's move on to the next pattern or the chart. So basically a doji pattern. Okay, so as you can see here, the body is completely narrowed here and there is a complete indecisiveness. So market tried to move above this particular level, but they failed, and they moved to below this particular level, they failed, and again market closed indecisively in the middle of the candle. This we can call it as a doji. And in this also different doji patterns are there. So basically it means an indecision. So there is an indecision. For example, let's say if the market was moving upwards and suddenly you got the doji, that means you got the pause in the entire momentum or the trend. So here market can take the direction to the upward momentum and downward direction, because this particular pattern indicate the indecisiveness in the particular trend. Suppose market is moving downward and again we got the doji pattern here, that means there is a sudden pause in the trend. So after that market can trade while in this particular range, and after that it can take either upward or downward direction because it indicates an indecisiveness in the trend. Well, in the doji pattern there are different patterns also involved. With respect to that, there are some sentiments or there are some bias involved in those particular patterns. So basically here it is a dragonfly doji. It's like a similar pattern of the hammer, but still there is a very narrow range in between the open and close. That is why this is still the doji, but in the doji it is called as a dragonfly doji. So basically this pattern also indicates the positive sentiment, and similarly if we get a pattern similar to our shooting star, so then it indicates a negative pattern or the negative sentiment. So the basically, rather than the name of these patterns, what important is the psychology behind this pattern and the sentiment and the bias behind this pattern, which gives the clarity for us to take the better trades. So it was about the single candlestick patterns. Now let's move on to the next part of this video, which is double or multiple candlestick patterns. Because of that also we can form different strategies or different bias or different sentiments. So let's look into that. Here you can see, let me show you how this particular candlestick look like. So basically engulfing means covering the entire pattern or the entire particular candle. So here, as we said, it's a multiple candlestick. So in that, so assume this was the beginning of this pattern and there will be another block because it is a multiple candlestick patterns. In that, assume that this was the second candlestick. So here let me draw the wicks for both these patterns. And for a sentiment's sake, let me add the green mark here. That means it's a positive sentiment bias, this particular candle, the bigger candle, and the lower level candle color doesn't really matter here. It may be a red or it may be a green, doesn't matter. The main important color that you, or the sentiment that you have to look for in the engulfing candle. Engulfing means you can see the last candle, that means this particular candle, this candle was completely engulfed or covered by this major candle, and we need to see which sentiment was dominant in this big candle. So here we need to understand the psychology behind this pattern. Assume that market was trending downwards. Okay, so for example sake, let's assume that it was a bearish candle. Okay, bearish candle, but all of a sudden next day or the next time frame, market opened below the close of this particular candle. That means the sellers took the complete control in the open itself, but they failed badly, and again market closed above the open, and that indicates the positive sentiment overall in terms of the pattern. And this is a so powerful pattern, especially if it forms near any major support or resistance. It acts as a beautiful pattern. So in this particular case, market closed here, and that indicates the positive sentiment in the overall trend. The last trend was in a downtrend, and there is a higher possibility of this trend reversing in the positive direction. So this is the importance of this particular candlestick pattern, and this we can call it as an engulfing pattern. In this case, since it is a positive sentiment candles, we can call it as a positive engulfing. And in the same case, assume that Let me copy this. The same pattern, but assume that the market was trending upwards. Okay, so let me change the color. Assume that the market was trending upwards and assume that this was the positive candle, the first candle that you are seeing here. Assume that this was the positive candle, but next day or next time frame market opened here. That means buyers took the control in the open itself. They has to sustain that particular sentiment. But what happened here is that market closed here, which indicates the lack of strength in the buyers. And after this formation, we can expect market to fall or market to reverse its direction from the positive bias to negative bias, and this we can call it as negative engulfing. And similar to this, all the patterns, whatever the patterns that I'm going to discuss has a positive bias to it and negative bias to it. If it contains the positive bias, then we can call it as a positive pattern, whatever the pattern it is, and negative bias, for that we can call it as a negative pattern. And now let's try to understand this pattern in the real chart, how it looks in the real world. So let's look into that. As you can see here, this is the Nifty chart. Again, I'm taking an example of that only. These two candles, you can clearly see that market was trending downwards till this particular point of time, and market opened below the close of this particular candle. And as a theory, if they took the control in the open itself, they have to sustain that particular sentiment. But what happened here is we saw the big positive sentiment candle which engulfed completely the last negative bias, which indicates that there is a trend reversal or the sentiment change in the entire trend. And after that we can see that the market trended upward movement, and it was a continuous, and it was a change of the overall last downtrend. So in terms of the negative bias or negative engulfing candle, you can see here this was the very recent data of Nifty in the daily chart, this particular candle and this candle. So until this point market was trending upward, but after we got the negative engulfing candle, you can clearly see how the overall trend has changed. This is the importance of this particular candlestick pattern, especially at particular major support or major resistance level or the key level of the market. If this pattern happens, then there is a higher possibility of market to reverse its trend. Now in multiple candlestick charts, the next part or the next pattern is Harami pattern. It's not a Hindi word, so don't consider it as a Hindi word. Harami means in Japanese, it's a pregnant woman. So it's a kind of an opposite part of the engulfing pattern. The sentiment looks like this. Assume that the market was trending downwards. Okay. So we got a big candle here. We got a very big candle here, which is basically the negative biased candle. Okay. Let me mark this with red. Negative biased candle. After that, assume that this candle, okay, so it may be a bullish candle or bearish candle, but the moment we got the narrow range candle within the major candle here, that means it's the first sign of it, this particular pattern is that there is a short term pause in the entire trend. The trend that was trending in downwards, there the moment we see this particular pattern, we see that it is a pause in the entire trend. So in that particular case, it looks something like this. Okay, so this is the mother candle and this is the baby candle. That is why this pattern is called as Harami. All right. So in this case, first point of the Harami pattern is the importance of the Harami pattern is that it indicates the pause of the market or the pause of the trend. And after this, there is also a possibility, because see, when the market is trending so powerful and immediately that particular power got stopped, and we got the narrow range candle here, that indicates the lack of strength in the overall downtrend, and there is a higher possibility of market reversing in the positive sentiment. And this particular candlestick we can call it as a positive Harami. And if it appears, and it has to appear in the negative direction, and similar to this, if the market is trending upward, and assume that this was the big candle, the bullish candle, and after that we got a pause in the form of narrow range body, then there is a possibility of market reversing in the downward direction. Well, here is a classic example of this particular pattern working. So you can see market was trending downwards and we got a very big down movement here, and after that there was a pause, and in fact it is a positive candle, which you can see this entire body is within the first candle body. So this becomes the positive Harami. and we can see that there was a change in the entire momentum or the entire trend. So here is an example for the downward direction. You can see that market was trending upward here, but all of a sudden we got the doji pattern, and which was engulfed by the last candle here. You can see this entire range, this range is entirely engulfed by the last candle, which indicates the negative Harami. And after that we can see that was a short term reversal in the entire upward movement. So this was the significance of the entire pattern, Harami and the engulfing pattern. This was a multiple candlestick patterns. And now let's move on to the next important pattern, which is the morning star and the evening star. This is a 3 candlestick pattern. So here we can see, let me show you here. In this particular case, assume that this total 3 candles. In this case, market was trending upwards. The overall strength was bullish, but all of a sudden we got the pause by the doji, which is the second candle. And third candle, we can see there was a reversal, the complete reversal to the first candle. So this is 1, this is 2, this is 3. In the third candle, we get the reversal, and this entire pattern is what we can call it as an evening star. Evening star, just because it is appearing in the upward direction. For example, market was trending upwards, and after that we got some bullish candle, and second there was a pause by the doji or the narrow range candle, and after that there is a reversal in terms of the bearish candle. So if that case, we can expect market to reverse in the opposite direction. And similarly in this case, you can call it as an evening star. So what is morning star? It is a rise. Okay, so morning star indicates a rise. In that particular case, that's a positive sentiment pattern. So for example, let's say market trending downwards, and assume that this was a negative bias candle, and after that we got the pause in the form of either the doji or the narrow range candle. And after that, if there is a rise or if there is a bullishness in the market, so let's say it's a positive candle, in this case this pattern, this 1 2 3, this entire pattern we can call it as morning star. Morning star. So this is the importance of this particular pattern. So basically this appears at the reversal or at the important crucial or key level. So when that happens, we can expect the trend reversals. So here is the morning star pattern in the real chart. So this was in the downtrend, and we can see after this particular candle, this is 1, this is 2, this is 3. In the first candle it was negative biased, and after that we got the doji here, which opened below the close of last particular candle, this particular candle, but there was a pause, and after that there is a rise. So this pattern we can call it as, this is indicates a positive sentiment, and it's called as a morning star. So far I have explained you the most critical and most important candlestick patterns, but there are many patterns which can be formed. But if you properly understand these particular candlestick patterns, obviously you can form more than 65 patterns by using the same pattern. But as I said, more than the pattern, the psychology involved behind that pattern is very critical, and you need to understand that particular point. And most of the time we see these patterns in between the trend, which is not the right way to use the candlestick charts. If you want to use it properly, refer to these particular patterns at the critical levels like support or resistance, and nearby any particular major key levels of the market. So where if these candlestick charts are forming, then there is a higher possibility, and that adds the more significance for these particular patterns. Well, this was about the candlestick charts. Do let me know in the comments what you have learned in this particular video, and most importantly, if you are new to our channel, kindly consider subscribing to the channel and also click on the bell icon to get the regular and interesting updates about the trading. The information that I have shared so far is for educational purpose only. It is not a buy or sell recommendation. Before taking any decisions in stock market, kindly do thorough research and then take the decisions, because stock market investments are subject to market risk. I hope today's discussion and today's information added value to your trading and investing. If so, why not to like this video and share this with your friends. Said that, I want to end this video today. See you in the next video. Until then, take care. Bye bye. Jai Hind.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.